and move on to our next panel, which is going to be about managing risks. That's easy, right? You buy low, sell high, and then you keep your fingers crossed in between. That's done. The panel will be Eva Sanchez, Chief Legal Officer of GSR, Philippe Bekhazi, CEO of XBTO Group, Ryan Selkis, Founder and CEO of Messari, and it will be expertly moderated by our very own Mark Mueller-Eberstein. And there are two types of people in this world. There are the Taylor Swifties and there are the Microsofties. So please welcome on stage.
So after we got all very scared by Nick now about what's happening on the security side, let's talk how professionals are actually handling this on a day-to-day basis, how you're making sure that your organizations are thinking about these risk issues, figuring out what the attack surfaces are, and how to manage them in a professional way. There are multitudes of risks, of course. We were going to talk about some of those technical and human risks, but I think let's start with the regulatory risks first. Because we have seen, I think, it took 10 years to get the ETF through. How difficult these things are, and as a good friend of mine once said, never argue with a guy that has a gun and a badge, because it's going to be really, really hard. Let's start with the first question. So, what impact do you think does regulatory risk pose in general? Is it a significant obstacle, or making it out more than what it looks like? We'll start with you, Ryan.
I think when FTX collapsed in November of 22, the second order effect that was the most dangerous was the political fallout, particularly in the US. And we saw a pretty significant overreaction to those events in the US, partly because of how active Sam Bankman-Fried was in DC and how instrumental he was in getting a market structure bill pretty close to the finish line with some of the folks that he had donated to and splashed quite a bit of money around to get the attention of in the lead up to that collapse. So that second order effect, I think, was something that we navigated throughout 2023. The silver lining is that the third branch of government in the US, the courts, delivered a series of victories for the industry throughout the course of 2023. So, of course, we wouldn't have an ETF if Grayscale hadn't sued and proven that the SEC was arbitrary and capricious in denying their ETF conversion application. We would not, I think, be in the same political position if Coinbase was not very aggressive in defending itself and essentially making no changes to its business because they believe that they have a good case and they're going to appeal and kind of fight that battle with the SEC in courts. And I think a lot of politicians and some members of the regulatory regime that are dissenters from current leadership tend to take Coinbase's side. And then, of course, we had Ripple defeat the SEC in court for similar reasons and essentially say that that agency had overreached in their definition of what constituted an investment contract. So I think the regulatory risk probably hit its zenith in the few months after FTX because people were looking for a throat to choke. And you can never blame yourselves for being taken by a charlatan. So you have to basically point to all the good actors that remain. That's essentially what happened, right? And I say that a little bit more plainly than maybe some other folks. But I do think that the result is in the U.S. a healthier environment in 2024 and beyond when it comes to crypto. But you're essentially talking about almost three different types of assets within the ecosystem. There's Bitcoin, there's some of the older network tokens and those assets, and then you have some of the emerging assets that kind of look like on-chain companies and they have earnings, and so they're probably under a bit more of a microscope and they have less capital to battle these regulators because it's helpful to have a gun and a badge, but if you have as much money as some of the folks that won in court have, then you can counteract.
Yeah, having a good lawyer makes all the difference. I think we've learned that in life.
That only works if you have a lot of that dry powder. So I think there's three different ways to look at that.
All right. This is the U.S. is the biggest financial market, but a very U.S. perspective. Philippe, I think with XBTO, you are looking across the globe, right? Many different organizations. What's your perspective there?
Well, we look at things internationally, because it's easy to look at things from where you're sitting at your desk, and I spent 20 years in New York sitting at things from New York and the U.S. And of course, the U.S. is one of the biggest economies in the world, the biggest economy in the world, actually. And so it's easy to be clouded by that. And then so you're looking at the SEC, you're looking at the CFTC, you're looking at FINCEN. But there are many other regulators around the world that are relevant also when it comes to crypto. And so in recent times, we've been all focused on what's been happening in the US. But other regulators have had issues, in Singapore, in Hong Kong recently, some scams. And, I think it's a global issue, right? So crypto is borderless. It's everywhere. It permeates from every layer of the social strat, right? Yeah. And we have to look at it from that perspective. There are people in Africa, there are people in Asia, there are people in Latin America that need access to stable coin, the stable store of value, and that sort of is important to keep in mind. It's not only about futures and options and speculation and all that stuff that we hear about and in recent times we've been kind of hit with. So we recently moved to Bermuda. We've been working with Bermuda as a jurisdiction, as a regulator, and we try to simplify things just because it's easier to work with one regulator. The U.S. is very fragmented.
And if you're in charge of one organization, that makes it relatively manageable as well. But then I'm looking at GSR, who's basically working with all the exchanges that are out there, decentralized, centralized across all the different globe, really. Eva, from a GSR perspective, how are you seeing the different regulatory challenges across the globe, both for yourself, but also for the organizations you're working with?
Yeah, I think you touch on the right point, right? For us, it's not just about what are the regs that impact us and what we are doing from where, but what is happening with our counterparties, what's happening with our partner exchanges, what's happening with our clients, where are they based? So we're in a 24/7 market, to Philippe's point, right? So we have to operate 24/7. We have to service clients wherever the business comes from. And let's face it, business comes from the US to a very large extent. So we have to be able to service clients in US hours. That is really important. Where does that land us? I guess where that lands us is we come up with what I have termed a lit and a dark market strategy. So we have people that are able to operate from an unregulated background, let's call it. Not because they're doing something illicit, but because actually in that jurisdiction, our activity, we're not an exchange, we're not a custodian, we're an intermediary and a prop shop. We are not regulated, so it's unregulated. But then we also have to think what's happening to our counterparties. Binance is probably the best example, right? The CFTC very aggressively went and redefined the regulatory perimeter of what a US person means. And that has had implications for somebody like GSR in terms of how we then have to set up our trading operations in the US in order to be able to meet those, effectively, those representations that we have to make. So the upshot is I like to think about it as it's a spectrum, it's a risk spectrum. And part of my role here at GSR is to land us on the right side of the spectrum. Nothing is riskless, right? But then we're in the business of taking risks. So we wouldn't get paid if we weren't taking risks. It's just, is it calculated? Is it considered? And are you looking at where that leaves you overall?
So I'll get back to the regulatory risk in a second, but you mentioned the counterparty risk. So I want to stick there for a little bit longer. How do you assess the exchange risks? What's the process? How deep do you go with your counterparties? And then I would love to go back this way. What are the best practices? What do you see in the industry there?
Sure, yeah. Well, I mean, it's a matter of public record. GSR was clearly exposed to FTX. Our practices vis-a-vis centralized exchanges and how we hold our assets have clearly dramatically changed. We now have a due diligence process that is very thorough. We sweep excess assets from the exchange. We work with crypto. For example, I was talking to the CEO of a Swiss crypto bank yesterday about the tripartite arrangements, and other panels have discussed it as well, where our assets can be held with a third party, but they can be accessed for the purposes of collateral. We work with exchange loans, where we agree terms with the exchange on how we can borrow basically tokens and use them as part of our trading. So it's a myriad of things, and certainly what goes beyond pure exchange risk is when we look, for example, at proof of reserves. We no longer just look at proof of reserves. We now look at audited accounts, because proof of reserves looks at the asset side, but what's happening on the liability side? So if there's one good thing that's come out of crypto is, I think we've all sharpened our pencils, and we have got now a focus on exchange risk that comes from the top, as opposed to something that was handled by, let's call it, the risk function at the firm.
So Eva, you're saying if I would put on Bermuda shorts, I would not get $1 billion loan right now, right? We would actually look what's happening. Okay. How does this look like for your side, from your side? Counterparty risk, what have you seen? What works?
Happy to
How
take
things
it.
have changed?
We've been doing this since 2015, and our first big issue with counterparty risk happened in July of 2016, the Bitfinex hack. That was our major exposure as an entity, and from then on, we really learned a lot from what to do and what not to do with exchanges. Obviously, an FTX is different from a Bitfinex. When there's fraud involved, it's very difficult to ascertain whether your funds are safe or not, because they can have all the best structure in place, but if someone's fraudulent, it's very difficult to sort of know that you're not going to get screwed tomorrow, right? So, if you assuming good faith and assuming that someone is using the proper market standard way of custodying coins, and of course, since 2016, technology has improved dramatically, right? What we now do is, to Eva's point, we try to, as much as possible, diversify where we put pockets of collateral. If we can disintermediate the collateral, whereby someone will take a bilateral credit risk, so that we don't have our collateral directly with an exchange, but with a trusted custodian that has all of the proper regulation and governance and technology in place. Obviously, we would prefer that, to the degree that it doesn't impact our trading, right? But I think importantly, in this case, diversification is very critical. If you had all your money at FTX, you did not live another day. And this is about surviving through cycles.
So you see, like traditional roles, traditional quotation marks, like custodians, their roles are evolving to support ongoing business operations more than just holding on the treasure, on the assets. I see. So is that what do you see across the industry, Ryan?
Well, we don't handle client funds. We're a data and research company, but I have a personal perspective on this, which is pretty simple, and that is avoid the lending business. When you're in crypto, right? It's a hyper volatile asset class. Securities lending will probably be you'll have an analog to that in crypto that will be healthy and vibrant at some point in the future. I would stay the hell away from it. Every single company that's gotten into lending has gotten crushed, almost without exception. I'd actually be interested to see if there's any exceptions. But it's been a money-losing operation, a principal-losing operation, basically since it took off in 2018, and even the biggest lenders have by and large all fallen by the wayside. And even those companies that did not have direct exposure to some of the nuclear fallout on some of these lending desks, they've significantly pared back their operations. So the names come to mind: Anchorage, Galaxy. I think we did relatively well, but that activity has basically just fizzled. I can say for us as a company, our greatest counterparty risk was with the U.S. regulated banks in March of last year. So we almost lost 20% of our deposits because of how disastrously managed SVB and some of the regional banks have been in terms of their treasury exposure. So the grand irony is that crypto companies need safe havens from the regulated banking institutions in the U.S. and if we had regulated stablecoins, I would certainly trust Coinbase's reserves and Kraken's reserves more than I would trust any of the regional banks. But I think at a super high level, I would look for anything that is regulated, fully reserved, provably fully reserved either through audits or proof of reserves, which is not perfect, but is probably good enough if you know that they're not in the lending business, because then the proof of liabilities doesn't really come into play.
So, Ryan, you mentioned stablecoins. So we had a lot of conversations about the different forms of stablecoins and government-backed central currencies over the last couple of hours here. And of course, Tether, there was a lot of discussions for many years, and now they are one of the biggest buyers of US Treasury bills. So how do you feel? And when we saw the crash of USDC at one point in time, so how reliable is that? How can we manage those kind of risks? Just pick
Either one.
Either way.
I mean,
yes. Yeah.
I'll go first, real quickly, just as an observer of that company and others in the stablecoin sphere. I think Tether is misunderstood from the traditional finance world because it emerged out of necessity, and some of its opacity has been by design, right? It's very much got its roots as a Wild West Eurodollar that was necessary in order to create, a stable quote currency for many of these assets on global exchanges. I think it was one of the most transformative companies and kind of breakthroughs for market structure within crypto. But most people in crypto trusted Tether because of its connection to Bitfinex and kind of their historical role in the market, and understood the trade-off was you're not going to have 100% fidelity of information, but you know that they're trying to play this game of arbitrage or to be very cautious about where their reserves are held so that they're not seized. So it was never about, are they going to abscond with our funds? It was much more, are they going to have the right financial relationships to make sure that their reserves are accessible at any time. And I think by and large they've done that. They've had a couple of settlements with various regulators that I think strengthens their position and minimizes the risk. They have the attestations now that come out quarterly as part of one of the settlements in the U.S. And when it comes to people still fear-mongering about Tether, there's a term in wrestling called kayfabe. It's one of my favorite terms. It's essentially like the play acting that goes along with all these like staged wrestling matches. And whenever I see something from a US or European regulator about Tether in particular, and it's shady and it's not regulated and this and that, I think it's all kayfabe. They love this thing because in the US at least, it's an offshore Eurodollar and they still have surveillance over it and they can still knock it politically whenever they need to, but they know that it's not going to do too much damage.
And they keep buying treasury bills, so that's quite nice.
And they keep buying treasury bills, exactly.
So that is a very optimistic outlook. Now, on the other hand, if you manage risk, how much hedging insurance do you have to take with a private entity? Or do we need the regulation in the UK or in the US coming up to making sure we have stricter regulation for trusting what's happening there?
Should I go?
Yeah.
Yeah, we certainly think stablecoin regs are the way to go. We were very supportive of the MiCA proposals, same for the UK prudential proposals that will look at stablecoin as well. Having said that, I'm a little bit in your camp in terms of Tether, and I think, clearly we do some hedging, but at the same time, it's fundamental to our operations, right? It's what our clients want. It's the oil that greases the wheels. And we've come a long way. So the attestations help. I guess it's a multitude of pieces that ultimately get us on our risk function comfortable on how we effectively balance the overall risk.
Okay.
That's really what I would say.
So I promised I'd go back to regulation, and you said we want regulation. There's a lot of discussions, of course, in the US, the congressional bills that are out there, potentially, or the proposals at least. There's a UK discussion, there's MiCA right now. How important, where do you think this is going to go over the next 2, 3, 4, 5 years? And maybe start with you, Philippe.
Well, so we started in Bermuda. We felt Bermuda was one of the earliest jurisdictions to actually understand the technology. That's critical because having regulation for the sake of regulation doesn't really help. BitLicense, for example, really did not help New York. I think it was early, it was restrictive, it didn't help the customer, it didn't help the provider. It just didn't really help foster the ecosystem in New York specifically.
And it didn't help the investors that got blown up from some of the BitLicense
Exactly.
entities, so.
Didn't help anybody, really.
So I think Bermuda has done a great job doing that. Other jurisdictions are coming along. Switzerland's been also an early one. It's been a good one. I think the UK has been a little bit behind, but they will get it right. I am certain of it. MICA is coming along. And then you have upcoming jurisdictions like Dubai and Abu Dhabi, where we're focusing on our efforts in Abu Dhabi specifically. And then, Singapore and Hong Kong, I think to a certain degree, are also going to very, very important. Singapore is very important. Hong Kong, we'll have to see how that goes. But yeah, so I think good regulation, well thought out regulation that encapsulates the use case, all of the use cases, is critical. Because otherwise, what you end up with is overly restrictive regulation, and then you don't really actually address the market. We've been involved in a number of companies that have a great product, loved offshore, that cannot fit right now in the U.S. market. And therefore, what ends up happening is they cut out the U.S. market. And you can only access it from the international market. And that's too bad, right? So one day, I think we'll get it, in the U.S. The U.S. will get it right. I'm certain of it. It'll come. It'll take longer because of, a lot of different reasons, political reasons.
How politicized it is.
How fragmented.
You're very optimistic,
Yeah.
yes. Yeah, eventually they will do the right thing, right? After exhausting everything else. So, I mean, you mentioned we have to be thankful for the lawsuits, right? So, is that the right?
That's always equipped that the U.S. always does the right thing after all other options are exhausted. But that's better than MiCA. I don't think that this is going to be a positive for the EU in the long term from an economic competitive standpoint. I mean, GDPR has basically given us pollution on every single website we visit. There's AI regulation from a jurisdiction that hasn't really shipped anything innovative. And I think that MiCA is basically following that same path. Sometimes there's high fives in Brussels that don't lead to any commercial success or good outcomes. And so I would argue that in the US and in certain jurisdictions, sometimes the answer, as uncomfortable as it is to push back. Right? I mean, that's what the rule of law is all about. So, back to your point about the guys with guns and badges, that's about as dark and dystopian a future I can imagine if you're not allowed to push back peacefully in the courts. So, you can say what you will, and I know even in the U.S., we all know how dysfunctional the U.S. political system is right now and how fragmented and polarized everything is. This year is going to be a nightmare in terms of the election that's coming up. No one's looking forward to the two candidates that are going to go head to head. But I do think that at the end of the day, there are times when that gridlock is by design and it's baked into the design of the system, because ultimately when the idea whose time has come is inevitable and lawmakers must grapple with it appropriately, compromises will be made and better law will take shape, whether that is in 2026, 2028, 2030. And in the meantime, we are in this gray zone, but that's not necessarily going to stop the innovators, because a lot of innovation happens in gray areas in history.
So it's making sure you understand the risk, you manage them correctly. Is that the right approach?
Yes, I think that's the name of the game right now. There's no question. And picking your jurisdictions where we want to be active. Like we probably won't set up shop in MiCA in the EU because of the straitjacket that MiCA represents. It does create a level playing field for good or for bad, but it is a straitjacket nevertheless. I do worry in the US. I know everybody talks about, oh, we're in stalemate mode. We've got the elections. Nothing's going to happen. It's so partisan. I do think the latest proposal from Senator Warren, I think it's called the Digital Asset Anti-Money Laundering Law. It's a mouthful. I think if you look at that piece of legislation and the narrative around national security concerns and money and the hacks that have led to money being, well, actually tokens rather than fiat, flown to North Korea for their nuclear missile program, I do think that's dangerous.
Because the 600 million last year?
Yeah, and that could lead, if there's one area where there could be bipartisan support, is national security. And if that gets distorted and leads to a piece of legislation, the US is in a bad way, because then basically software developers, validators, they will all have to register as financial institutions. So I do hope that's not where it ends up. A cynical could say that Senator Warren has a track record of proposing legislation for fundraising and for other purposes, and not a good track record of passing law. But nevertheless, I do think there is actually some concern around the US right now.
I'm happy to touch on that in particular, if it'd be helpful. So first of all, I completely agree. I think when we think about what positive legislation could come out in the U.S., it's basically nil, right? There's court victories, and then there's avoiding some version of that. There's a similar bill which is sponsored by more moderate senators called CanC, which is very similar to DAMLA, which is Warren's bill. And they're both focused on national security, which is why you've seen them plant these stories in the Wall Street Journal and essentially use crypto as a scapegoat for every evil that happens, in the world, whether it's, Hamas or North Korea laundering money. And these are real problems, and we have people that are working on this. And arguably, the transparency of these blockchains is held against us because everything it's a permanent digital paper trail that you can ultimately, forensically, identify certain bad activity. But it's often misinterpreted information. It doesn't really matter when you're talking about making policy. So stopping that in its tracks and solving that education problem just so nothing bad happens this year is probably priority number one. But on the point about Elizabeth Warren, in the meantime, most of the damage is done through personnel in the administrative branch. And Warren in the U.S., there's the perception that she's not very influential because she never passes bills. But she happened to run against Joe Biden for the presidency, and when she endorsed him, she helped put him over the top in the 2020 election. And their devil's bargain, which is the least well-kept secret in D.C., is that she was going to have a say in financial personnel in his administration in return for her support. And that's how Gary Gensler, who is a close ally of hers, is the SEC chair. The National Economic Council Deputy Director, Bharat Ramamurthy, was our number one adversary. No one in this room, I guarantee, knows his name, but he was our number one adversary within the White House, putting pressure not just from the White House on the other executive branch administrators, but also on the House, Maxine Waters and folks that were working on bipartisan bills to basically put pencils down and not cooperate with the Republicans. That was a former Warren chief of staff. He retired or resigned from the White House in September. He was replaced by Senator Warren's current chief of staff. So there's this very tight tie that she has to every single financial regulator, and that personnel in the White House.
Now I'm even more worried.
That trickles down is extremely damaging. So I would say the most important thing that must happen in the U.S. politically, and I know it's toxic to get into presidential politics, so I won't. But the Republicans must win the Senate in the U.S. if we're going to avoid really terrible outcomes for the industry, because Warren will otherwise be in a position of power through her committee membership and be able to exert this influence on an ongoing basis, regardless of who wins the next administration. So
I'll take the bad state actor argument to get my inner geek out and talk a little bit more about the technology as well. I mean, the Koreans are North Koreans are very, very deep in understanding where the vulnerabilities in our ecosystem are and exploiting them wherever they can. That's, 600 million, I think, was the number for last year. How are we thinking about the smart contract risk in general, the industry, as we're going into DeFi, as we're going into leveraging all these protocols we've talked about here over the last couple of days? How can we do better? Because when we say contract is or code is law, that's probably not the right approach, would be my guess.
At the end of the day, you have centralized counterparty risk, and then you have decentralized counterparty risk. Different counterparties, obviously. One is someone you can call, someone that you can legally sue, someone that is basically usually an entity, a person, pretty familiar. You got case law going very far. And then you have on the other side a completely new technology called a smart contract that most people interact with without really understanding it fully. Right? It's like reading Apple's terms of use every time you update your phone. Who reads that? No one, right? But with smart contracts, you have money at risk, right? And so every time there's an update to the smart contract, well, guess what? You better go and read it because maybe they've opened a vector of attack that you didn't know of. And so it's an ongoing thing. It's not for everyone. I think we're very, very early on trusting smart contracts blindly, to be honest. We've been very slow at deploying significant amounts of funds in smart contracts for that reason. And actually, I think we've put in $1 million last year, only $1 million, and we lost to hacks 30% of it.
I want to take this is the biggest.
And we know what we're doing.
Yeah,
I hope so.
So I would say to date, this is one of the biggest risks in crypto. I am actually very optimistic about this getting solved sooner than maybe most people think, especially given how broad the design space is and the complexity and the surface area for attacks. But I think the combination of the wallet wars that are upcoming and the foot race from some really large, well-funded entities that are exceptionally talented, whether you're talking about Fireblocks, Coinbase and their wallet, MetaMask, Safe, I know spoke earlier. These are entities that are securing, billions or I think even at this point, hundreds of billions of dollars of value. And I do think that ultimately those self-custodial wallets will be instrumental in building security safeguards and maybe AI-driven scripts that will help you, in plain English, understand what is happening with a given smart contract. So you will probably always have these tail risk events, but over time, you can only do the same hack once, right? And then it will get patched, and it will get patched, I think in aggregate by, some of the largest entities in crypto that have some of the best security engineering teams. So you'll gradually, whittle down and make anti-fragile the surface area. And what you see now is a huge risk where you lose money to a hack and then it gets laundered by Lazarus in North Korea, and it becomes a huge thing that could potentially hurt the industry forever. I think that gets patched because it's an existential risk that we need to solve for in order to just take that political attack vector out, not to mention safeguard consumers and ultimately, win the market share in that wallet ecosystem.
So one theme I think that came across is a lot of changes coming over the next years, maybe a lot of uncertainty I think that's out there, both technology-wise but also policy-wise. Would love to have one more quick round and say, what do you think is going to happen over the next 18 to 24 months in general in this space? And how can organizations, but also investors, prepare themselves to making sure that they make it through the next 24 months as well as possible?
I think somebody on a previous panel, maybe two panels before this one, said the best thing that could happen is that we don't have another blow up. And truthfully, I'll be happy with that. If we don't have another blow up and the industry continues to mature, and we continue to work with innovation, like around smart contracts, I completely agree. Fireblocks are doing a ton of good work. Not that I'm pitching for them, but it's undoubtedly the question that the solutions they are bringing to the table, for example, are not only operationally workable, but they're also commercially operable, right? This is the thing. Often you end up with a legal solution that legally may sound good, but actually it's totally unworkable. So it doesn't or the alternative, you have an operational setup, but actually the legal basis does not underpin and give you the confidence to say, yeah, we can adopt that. So to me, if that happens and the market continues to basically steadily recover, and we have no horrid piece of legislation coming out of the US, that's probably a good place to be.
I'm going to be a bit darker, but I'm just going to say every 10 or 15 years, you're going to have a blow up of the scale of an FTX, of a Madoff. And it's not necessarily because of the technology. It's because, well, we're all humans. We all make mistakes. And obviously, fraud is sometimes very difficult, as I was saying, to pinpoint and to identify. But generally speaking, as we build more technology, more guardrails, and hopefully learn and keep that learning for longer than just a few years, because things
it's
people
like
tend
the
to
war,
forget.
right? You forget about
and
the
like
war.
a couple of years, you forget, and you start
Yes.
over again, and then you have a meteorite. But look, in a number go up kind of environment, as we have, we're seeing right now, with an ETF launch, with a halving in April, with a Fed that's probably going to pivot eventually, numbers are going to go up. So hacks are going to be more, they're not going to go away. So they're going to get bigger. They're going to garner headlines. And we just got to keep making sure that we all sort of individually survive. Right? We all gonna at some level lose some money somehow. I can't say you never lose any money.
Well, I don't
that
want
would
you
be so
to
great,
lose
right?
30% on
it's
a
just
regular
not
basis.
the
So
case,
would be,
and that's
would
the
be quite
reality.
painful, but yes.
Yeah, I think companies that have been in this space for a long time, what doesn't kill them makes them stronger.
I know Messari does a lot of research in this space. Maybe we can just wrap it up with your opinion and your organization's opinion. Where do we go?
If you want to manage risk, decentralize your personal systems or your company systems. It's just that simple. Have multiple custodians, have multiple kind of operating setups, hedge across assets. And if you do that, you're compensated for the risk, and then some, right? You are compensated for the risk historically in this asset class. The volatility washes some people out. The blow-up risk washes some people out. But if you're hedged in terms of where you are custodying and where you're placing bets, you can absorb even those catastrophic losses, even if you lost money in FTX, as long as that was only where you had 15, 20% of your holdings. You're still destroying every other money manager internationally.
For investors, the good old rule of diversification, right? So that makes sense. Eva, Philippe, Ryan, I could talk for a couple more hours on this thing, but good news is we have the bubbles afterwards, so we'll go and meet you there in the next break. But with that, I appreciate this conversation tremendously. Again, we can't wait to continue. Thank you very much, everybody.
Thank you.
Appreciate it.
Wow, thank you so much.
Thank you.
That's been great, guys.